What's going on, everybody? This is Coach Wade, and today I want to talk about something that most new investors completely overlook. It's not the stock market. It's not interest rates. It's not inflation. It's something much smaller. But over time, it can have a much bigger impact than people realize. I'm talking about expense ratios. Now, I know that doesn't sound exciting. In fact, some of you probably heard the words expense ratio and immediately thought, I'm about to hear a bunch of financial jargon. Don't worry, I'm going to keep it simple. Let's start with the obvious question. What is an expense ratio? An expense ratio is the annual fee that an investment fund charges to help cover the cost of managing and operating the fund. Think of it as the operating cost of owning the fund. Now, here's the important part. You don't usually get a bill in the mail. You don't write a check every year. Instead, the fee is generally deducted from the fund itself, which means it's reflected in the fund's overall performance. That's why many investors don't even notice they're paying it. Now, let me give you an example. Imagine two funds that invest in almost the exact same companies. One has an expense ratio of 0.03%. The other has an expense ratio of 1%. At first glance, you might think, Coach Wade, that's less than 1%. What's the big deal? Here's the big deal. You're not paying that fee one time. You're paying it year after year after year for as long as you own the investment. And that's where the math starts working against you. Think about it this way. Imagine you have a bucket of water. Every single day, someone pokes a tiny hole in the bottom. Now, one tiny drop doesn't seem like much, but if that bucket sits there long enough, eventually you've lost a lot more water than you expected. That's what higher investment fees can do. One small percentage, repeated over decades, can reduce how much of your investment stays invested and continues growing. Now, here's another question. Why do some funds have higher expense ratios than others? One reason is because some funds are actively managed. That means professional managers are trying to select investments they believe will outperform the market. That involves research, analysts, trading, management teams, and all those services cost money. On the other hand, many index funds simply track a market index. They're not trying to guess which stocks will outperform. They're simply following the index. Because of that, many index funds have relatively low expense ratios. Now, does paying a higher expense ratio automatically mean you'll get better returns? Not necessarily. A higher fee doesn't guarantee better performance, and a lower fee doesn't guarantee higher performance either. But here's what we do know. Fees are one of the few things investors can actually control. You can't control what the stock market does tomorrow. You can't control inflation. You can't control interest rates, but you can compare expense ratios before you invest. That's one reason I encourage people to understand exactly what they're paying for. Here's another thing to think about. Imagine two runners competing in a marathon. Both runners are equally talented. Both train the same way. But one runner has to carry a heavy backpack the entire race. Who do you think has the advantage? The runner without the extra weight. Higher investment fees can work a little like that backpack. They don't determine the outcome by themselves, but over a very long journey, extra costs can make a difference. Now remember, expense ratios are only one factor to consider. You should also understand what the fund invests in, whether it matches your financial goals, its level of diversification, its investment strategy, and whether it fits into your overall financial plan. Don't choose an investment based only on its fees, but don't ignore the fees either. As I teach in stage 4 of the 7 stages of financial independence, the wealth building zone, investing is about making wise decisions consistently. That includes paying attention to the costs associated with investing, because every dollar you don't spend on unnecessary fees is another dollar that can remain invested and continue working toward your long-term goals. Now, here's something I tell people all the time. Don't become obsessed with finding the absolute lowest expense ratio on the planet. Sometimes people spend weeks comparing two funds that differ by only a tiny fraction of a percent, while they haven't invested a single dollar. Remember, Your investing habits matters more than chasing perfection. Start investing, stay consistent, continue learning, and make improvements along the way. Here's what I want you to remember. Expense ratios are the ongoing costs of owning an investment fund. Those costs are usually built into the fund and reflected in its performance. Even small differences in fees can add up over many years because of the power of compounding. That's why it's smart to understand what you're paying and why you're paying it. I'm Coach Wade, and I believe building wealth isn't just about earning more money, it's also about keeping more of what you earn, making informed financial decisions, and allowing your investments the opportunity to grow over time. So before you invest, take a moment to look at the expense ratio, understand the investment, know what you're paying for, and remember, the little things you do consistently today can make a very big difference tomorrow. I'll see you in the next lesson.